Interest rates are on the rise and we've got a lot of people panicking about their remortgage renewals or the cost of buying a place now. So in this video, we're going to be discussing interest rates. Hi, my name's Sam. I'm a qualified mortgage broker and I'm here to help you in your buying or remortgaging journey. If this is your first time watching, then do consider subscribing to the channel and let's get into the video. So first off, what is the base rate? Well, the base rate is the interest rate that the Bank of England charge commercial banks to borrow money from them. Commercial banks will include mortgage lenders. Essentially, if the base rate is higher, then funding for commercial banks becomes more expensive. If the base rate is lower, then funding for these commercial banks becomes cheaper. The Bank of England monitor and make changes to the base rate in order to meet government targets. So the Monetary Policy Committee will meet regularly to discuss and review the base rate. At the time of making this video, so in September 2022, the target of inflation is 2% year on year. The only problem is that the inflation rate at the moment is 9.9%. That's what happens when you make a video at midday. So the base rate has fluctuated over time. It was introduced in 1694. We've had the high of 17% in 1979, and we've had the all-time low of 0.1% in 2020. Before the financial crash of 2008, we had a base rate of just above 5%. Following that crash, to help boost the economy, the Bank of England reduced that rate over time all the way up until 2016 to a rate of 0.25%. This had then dropped even further at a later date to an all-time low of 0.1% in March 2020 following COVID. Where the base rate had been so low for such a long time, it made mortgage borrowers very much accustomed to low mortgage rates. So it's no wonder when we started to see base rate increases from December 2021 that many people were starting to get worried and concerned about their renewal rate or the new cost of actually buying a home with a mortgage. You can always find out more about the history of the base rate on the government website, or you can always visit our website as well. I'll link both in the description below. So what happens when the base rate increases? Well, here we're just going to be talking about mortgages. So when the base rate increases, mortgage rates will tend to increase as well. Now, these mortgage rates won't necessarily increase in line with the base rate. It could be at a completely different percentage. There's lots of other factors involved. But increased mortgage rates results in increased monthly payments if you are on a lower rate beforehand. This leaves less disposable income, so less money in your pocket to spend, which then curbs inflation, or at least that's what the Bank of England are hoping for. So what happens when the base rate decreases? Well, it's the exact opposite of the increase in the base rate. So if the base rate decreases, the likelihood is that mortgage lenders will reduce their rates as well. Again, not necessarily in line at the same percentage as the base rate decrease, but they usually will decrease as well. And if mortgage rates decrease and then you end up remortgaging onto a lower rate, you'll have a lower monthly payment, which will make more money available to you, more disposable income to spend on other things. This can then help boost the economy. On a side note, if you want to see an example of how an increase in the base rate and then mortgage rates might increase monthly payments, then I've listed this on our website and I'll put that in the description below. So will the base rate hit the high levels up to 17% that we've seen in the past? Now, naturally, this is a question that we're getting asked a lot, particularly as we've seen quite a few base rate increases on the bounce. Now, the annoying answer is that I can't tell you whether it will get to that level again, and no one can predict that. But I can give you my personal opinion. So, as with any of these videos, they can't constitute advice, as I'm sure you know from watching the previous videos, but I can give you my opinion and you can do your own research and sort of gauge what you think from there. So my opinion is that although it's not impossible for the base rate to reach this level again, I do think it's highly unlikely. Now, the reason for that is because mortgage borrowers aren't the only borrowers out there. The government is a huge borrower itself. Now, if you compare the government debt back to 1979 to what it is now, then you'll find that the debt now is at a much higher level than it was. So where the government have debt themselves, they actually need to refinance that debt as well. So if the government's been used to borrowing at a very low interest rate and then suddenly the base rate goes up to 17%, and then they need to refinance that debt, it could actually force real worries for the government itself. If you do want to find out a bit more information about this yourself, then I will add a link to the description below, and I'll add a book recommendation as well that will teach you a lot more about this. But that being said, there's so many factors when it comes to deciding on where the base rate should be. There's also many factors that come into play when setting mortgage rates. So it's not just the base rate that will determine this. One factor might be that mortgage lenders want to be competitive with each other. So they might compete with a lower interest rate depending on how competitive the market is. Or another example might come down to what the swap rates are. Now, swap rates are very complicated, and we're not going to be going into detail on that in this video, but I will add a link below on where you can find out more information about that as well. But the important thing is that swap rate prices can determine the interest rates that a lender might need to charge. It can also hint at where the markets believe where interest rates will be in the next few years, but there's no guarantee, of course. If the swap rates are higher, then it alludes to the markets believing that the interest rates will be higher at that time, and vice versa for when the swap rates are lower. At the time of making this video, you see 1, 2 and 3 year swap rate prices being slightly higher, and then it decreasing slightly over 5, 10, 15 years. So how can you avoid the impacts of rising interest rates? Well, one of the main options that you can look at here is fixing your interest rate on your mortgage. If you fix in an interest rate, then if the base rate or the mortgage rates increase, you're not going to be impacted by that during the term of your fixed rate. On the opposing end, if you arranged a tracker mortgage or a discount rate, then you'd be subject to seeing that those interest rates change if the base rate changes or the lender changes their rate, depending on which of the two products that you went for. I hope this video has helped. I'll do my best to answer any questions that you might have. If you do have any questions, then list them in the comments below. As always, I must tell you that as a mortgage is secured against your home, it may be repossessed if you don't keep up the monthly repayments. Thanks for watching, and I'll see you in the next one.